Hello, hello guys, welcome to back and another video. So guys, today we are going to talk about the camels rating, about principles of management. So what is camel ratings? Camel ratings, the parameters of the on which the rating are done, represent are anonymous as camels: capital adequacy, asset adequacy, management quality, sensitivity, liquidity, and earning. So capital adequacy. What is the capital adequacy? The capital adequacy measures the bank capacity to handle the losses and meet all its obligations towards the customers without ceasing its operation. This can be met only the basis of an account and the quality on capital. A bank can access a ratio of capital or risk weighted assets determine the bank adequacy. Asset quality. An asset represents all the asset of bank. These current and fixed loan, investment, real estate, all the off-balance and transaction, gross non-profiting loans and gross advances is one of the criteria to evaluate the effectiveness of credit decisions made by bankers. Number 3. Management quality. The board of directors and top-level managers are the key persons who are responsible for the successful function of the banking operations. Through this parameter, the effectiveness of the management is checked out, such as how well they respond of the changing market condition and how well the duties and responsibilities are delegated, how well the compensation policies and job descriptions are designed, etc. Earning. Income from all operations, non-traditional and extraordinary sources constitute the earning of a bank. Through the parameter, the bank efficiency is checked with respect to its capital adequacy to cover all the potential losses. Ability to pay off the dividends, return on assets ratio measures the earning of the banks. 5. Liquidity. The bank's ability to convert assets into cash called liquidity. The ratio of cash maintained by banks and balance with the central bank to total assets determine the liquidity of the bank. Sensitivity of market risk. Through this parameter, the bank's sensitivity towards the changing market conditions is checked, i.e. how advantage changes in this interest rate, foreign exchange rates, commodity prices, fixed assets will affect and its operation. Thus, through camels rating, the overall financial position of the bank evaluated and the correctiveness, if any, are taken accordingly. So what's our next question? Our next question is clearinghouse. What is clearinghouse? A clearinghouse is a financial institution formed to facilitate the exchange of payments, securities, or derivatives transactions. The clearing house stands between two clearing firms. Some of the definition is clearing house are given below. According to the Investopedia, I repeat, according to the Investopedia, a clearing house is an intermediary between buyers and sellers of financial instruments. According to Random House Dictionary, clearing house is a place or institution where mutual claims and accounts are settled between banks. According to Cambridge Dictionary, a clearing house is a central office used by banks to collect and send out money and checks. According to a HarperCollins, a clearing house is a central bank which deals with all the business between the banks that use services. Why clearing house is necessary in banking sector? A clearing house is a central bank which deals with all the business between the banks and that uses service. Clearing house is necessary in the banking sector of the following reasons. 1. Reduce cost. Why clearing house is necessary in banking sector? Reduce cost. Clearing house reduce the cost involved in the collection of checks and claims. Avoid delay. Clearing house avoid delay in the clearing and checks. Avoid. Ensure convenience. Central banks ensure convenience and economy in the settlement. Minimize risk. Central bank minimize the risk involved in the realization of checks. Minimize holding large cash. Clearing house minimize the necessity of holding large scale balance by commercial banks. Common platform. Clearinghouse can be used as a common platform for the problem and functional members. Common cooperation, go information of liquidity, offer valuable data. Islamic banking. Our next term is Islamic banking. What is Islamic banking? Islamic banking is the banking system which is governed by the principles laid down by Islamic Sharia. In broad sense, Islamic bank is an institute that mobilizes financial resources and invest them in attempt to achieve predetermined Islamically acceptable social and financial objectives. While Islamic banking has a broader scope and meaning, it is generally referred to as transformation of conventional money lending system into asset-backed financial transaction conducted by the financial institution. Sharia Islamic law. What is Sharia and what is Islamic law? Sharia lexically means a way or path. In Islamic, Sharia refers to the divine guidance and laws given by the Holy Quran, the Hadith of the Prophet Muhammad sallallahu alaihi wasallam, and supplemented by the juristic interpretations by Islamic scholars. Sharia embodies all aspects of the Islamic faith, including beliefs and practice. Islamic Sharia, on the other device law of Islam, is derived from the following four sources: the Holy Quran, the Sunnah of Holy Prophet, peace be upon him, Ijma, Qiyas. What is meant by Sharia Islamic law? Now we will going to try to define this. Okay. Philosophy of Islamic banking. The philosophy of Islamic banking takes the lead of Islamic Sharia. According to Islamic Sharia, transaction involving interest, riba, gharar and measure prohibited. Moreover, they cannot deal any transaction subject matter which is invalid haram in eyes of Islam. Islamic bank focus on generating returns through investment tools which are Sharia compliant. Islamic Sharia links the gain on capital with performance operating in the ambit of Sharia. The operations of Islamic banking are based on Sharia. The risks which arise through trading, investment activities using contracts and various Islamic modes of finance. Riba, gharar and maizar. Riba, gharar and maizar. What is riba? Riba, an increase stipulated or sought over the principle of a loan or debt, implies any excuse compensation without due consideration. Gharar, excessive level of uncertain and ambitious created to the lack of information controlling control. Maizar, does interest riba is related only to consumption loan or it applies in commercial loans also? The interest is prohibited whether it is consumption loan. There are quite a number of hadith which clarify that in the Holy Prophet people not only borrowed a consumption purpose. Principle of Islamic banking. Islamic banking, both mobilization and investment of funds should be conducted and accommodation of the Islamic Sharia. Provided interest in usury, ethical standards, moral and social values, liability and business risk. Here is today. See you tomorrow.